the main difference is that retail traders are reacting, whereas market traders are anticipating. And that comes back to what the market is in the first place, how it is designed. It's designed for if a small amount of people or institutions or whatever want to consistently make money and consistently get money out of the market, then the large sum of people, retail traders, need to consistently lose money. And it does not look like a monthly fee that you pay, right? You're trading, but overall, even if you're doing well, I'm sure you've known if you're trading, like you're doing well maybe for a week, a month, a year even, and then suddenly this one day or a trade comes where you just lose all your entire account or all your profits and then some, right? And that's literally when retail traders, institutional traders have a payday, right? And how do they do that? Well, they understand, really is they have an exact strategy that they're following in simple terms, right? They understand how the market is working, why the price moves where it is, and then based on that, because you actually understand the core market dynamics, you know how to influence them in the first place, and then second of all, you can utilize that knowledge and make specific strategies for specific market movements that are consistently true. And that's the trick. So making sure that your strategy is so simple or based on the most basic dynamics, so it is consistently true no matter what coin you look at or no matter what time frame you look at. And because of that, because you find something like that and then you're able to consistently apply it, you will see consistency. Whereas if you have a strategy and you just overfit it, so you just overcomplicate it, try to fit it into one specific range or something like that, or you don't have a strategy in the first place, which is what most retail traders do. They just trade off a feeling, and that's fine. If you are an intuitive trader, that's okay, but even then you have a strategy, your risk management, your profit taking, what ranges you're working with, right? So they do not jump from strategy to strategy. They have one exact strategy that they're trading with, and they can have multiple, but every single one of them is back tested and worked on the same way, and they understand all strengths and all the weaknesses of a strategy. A good example is, I can just go over it real quick. A good example is what we have done for our investors, for our hedge fund, which is that we have separate strategies, right? Like for example, here we have our Phantom strategy, which is essentially a trend following strategy and follows the Phantom trend really. And it's one of the altcoin strategies, and the way it works is that it just creates, it follows big trends, and Phantom usually tends to move a lot, so that's what it's based off of. And then we have something very similar with say Solana. Let me just load it up, which is a strategy that also follows trends and usually works well in bullish markets. Now that's one thing, right? But then we also have strategies that are more consistent, say the ETH Turtle, for example. And now those strategies, they're not as profitable, but they're very, very consistent. And as they are consistent, you can see the equity curve. I should probably show you the bully here. As you see them, they all work for different reasons. They're all different strategies, but the trick is to see, okay, how do they work? Like the ETH Turtle, for example, is a trend following strategy. The BTC Bully that's loading up right now is a trend reversal strategy. And what that means is that, and see how consistent this one is, and what that means is that as we're trading both of them together, let me show you. Okay, so we're in a range here, right? We're in a range, and one very basic core market principle is ranges and trends in the market. So essentially, the theory is that we basically have ranges, and the market's either in a range or going from range to another range, right? Oh shit, sorry. I'll share my screen. I'll share my screen. Okay, so what I was showing was the strategies on the dashboard. The bully, very consistent strategy. The ETH turtle, which is a more, so this is a trend reversal strategy, and then the ETH turtle is a trend following strategy, and then we have our big trend following strategies, which are altcoin strategies. So so based on that, we're going over the basic core market principles and how this works. So this is the turtle, has been doing pretty well in the past, obviously trend following strategy, right? The bully is a trend reversal strategy, and now if we go to say Solana, that's a trend following strategy as well, but it's on an altcoin, so those moves are much bigger. And the reason I'm showing those three as an example is very specific, because as you can see, the Solana strategy is doing pretty well, for example, but it has much bigger moves. So one very basic core market principle is that we have ranges, and then we have trends in between those ranges, right? So we're either in a range or we're moving from range to another range. So how can you trade this? Well, most basic ways of trading it is saying, first of all, you can trade the range, right? So you can say, okay, and that's a trend reversal strategy. So every time we get to the top of the range, right, once it's established, every time we get to the top of the range, and we have some other indicators and confirmations, then we're shorting, right? Top of the range, we're shorting. Bottom of the range, we're longing, right? Very simple, up and down, right? And so most of the time, we're going to be right in a trend reversal strategy. And as opposed to it, you have a trend following strategy, which is a range. But then instead of bouncing back down from a range, you break up and move to the other range. And that's a trend following strategy, right? So a trend following strategy, that within a range happens only once, but the move is much bigger. Whereas when you trade the trend reversal strategy, you're actually going to be right much more often, but the moves are smaller in general, right? The key thing here is, though, we need to understand how the strategies work, right? So a trend reversal strategy, when does it work? It works when we get to the top of the range and we reverse back down, and bottom of the range and we reverse back up. That's when a trend reversal strategy works. When does a trend following strategy work? A trend following strategy works when we get to the top of the range but break out, right? So when the trend reversal strategy stops working, that's when the trend following strategy starts working, and vice versa. If we are trying to do a trend following strategy here and we break down, then that's when the trend following strategy is not working, but that's when the trend reversal strategy is working. So what that means is that a trend following strategy, for example here the ETH turtle and the bully, the trend reversal strategy, they're negatively correlated, meaning that if one, like when one works doesn't work, the other one works, and vice versa. And because of that, when you bundle them together and trade them at the same time, then your equity curve will actually be much more consistent. Like here, these are three strategies actually: ETH turtle, ETH bully, Bitcoin bully, and they're trading at the same time, right? Our best bundle, though, bundle number 4, it has much more allocations and much more indicators and much more strategies. And there you will see the actual consistency of how it would look like when you trade multiple strategies, a bucket of strategies that are all negatively correlated. Because what that means is that all of them, help each other out, right? So that's a very important mechanic or really reality that market makers understand. So when I build a strategy, or when market makers build a strategy as opposed to retail traders, they don't just try to look at their P&L and be excited when the price goes up and price goes down and then make 500%, and then for the next 3 months they're going to lose money, or they're going to make 500%, they're going to make 1,000%, and then they're going to lose 100. very, very quickly, right? Pretty much right away within a question of days. Like, I have not seen a person, and I've talked to many traders, I've seen thousands of traders, and I've not seen one single person that when they have been growing their account by like 100% a day, within 3 to 4 days, they would blow their account. And they would do it again and again and again and again. And that's literally what retail traders are doing. And that's literally how institutional traders consistently make money. Exactly like this. Because those retail traders get all excited and euphoric, but all that happens is that there is a consistent outflow of their account into the pockets of institutional traders. So that is the first thing that we need to understand, how the market works, right? You can be one of the 99.9% of traders and just lose money consistently, whether you know about it or whether you don't. You might know about it, you might just lie to yourself, have the fisherman syndrome where you just overshoot the size of the fish you caught every single time, mentally in your head as well. So you keep trading because of an idea or a dream that you want to achieve, but based on your actions, you're never going to get there because you're inconsistent and you will guaranteed lose money. If there was an index of betting on people losing money, that's the only thing I would be doing at all. I would not do anything else, and I'd make like $1 trillion a day because it's the most consistent thing ever, right? So this is what market makers do. They have an exact strategy that they trade. If they have multiple strategies, then those strategies are negatively correlated, meaning that they're not just more strategies for the sake of having more strategies. They're actually thought through in order to make sure that the overall account that's trading those strategies actually has the highest chance of success and the most consistent returns that they can have. This is a very, very straight line, as you can see. The only time they really shoot up, sometimes the profits shoot up a lot, and that's usually because of the altcoins having a big move, which usually those strategies catch. As you can see, you can mess around with the allocations as well to see how different that would be. I could probably, if I just put say 25% on FTM and took it away from the bully, then you would see the difference. So yeah, that's but that's besides the point. What market makers do is they have an exact strategy. If there are more strategies, then those strategies are negatively correlated and they're helping each other out. They do not jump from strategy to strategy just because they saw it on a YouTube video or just because someone else that they know have made 1,000% because they just did something that doesn't really make sense. Like outside of a bull market, in order to succeed in trading, you need to be consistent and you need to make sure that that you understand what you're trading and you do that every single day. And a very, very good thing here is to use some form of automation or some algorithm, something like that just helps you with making sure and so it helps you to be consistent every single day, and you don't have to do all those calculations in your head all the time, because that is something that's mentally draining, first of all, and second of all, you are increasing the probability of mistakes. In the bull market though, there's this one rule that will always be true, which is that your dumbest friend will make the most money. And it is something that might drive you crazy, but it will happen every single time. Why, I cannot explain. It's a core market dynamic that is way more advanced than anything else that I will ever cover. So just know that. Market makers understand all strengths and weaknesses of a strategy, and because of that, because we understood, like us for example, we understood the weaknesses of a strategy, we could bundle it together with a strategy where the weakness of one strategy is the strength of another strategy. And what's the result overall? The result overall is that you have a consistent line up. So we know when it works well, we know when it doesn't work well, which is more important than that, right? That's the thing that you want to focus on, and that's the thing that retail traders don't want to focus on. The main part of institutional traders, what they're going to be focusing on time-wise is the weaknesses of a strategy, whereas where retail traders are going to be focusing on is where it's the best. There's, 1 out of 10 times it might have a good trade, so they'll spend all their time of maximizing that one trade that's amazing, but 9 times it's just going to shit the bed. So that's also a main difference. I've told this story once already, but I'm just gonna brush over it real quick, which is that a few months ago I was in Colombia with a client. It was an automation client, and there was this group of guys, and they were all really successful in whatever they were doing. Not all of them were traders; they were doing other stuff as well. But there was this group, and like they were truly impressive. But the thing was that, first of all, every single second of the day that we were together, it was all the time, it was just business, but not just, talking about it. It was high intensity business. After 30 minutes, my brain started hurting every single time. So it was that thing. And then there was one guy, I don't even remember his, I do, let's just call him Ben. And this one guy, I thought at first I didn't like him because it was so negative. Everything that we said, he just found something negative about it. And then over time, I learned that he's actually not negative. But what he's doing is he's the control of the group, right? So any idea that's talked about, he's trying to break that idea. He's trying to break it. He's trying to find a way how it would not work. And when he does, then the rest of the group needs to find a way how to overcome that obstacle. And that has been going on for I was there, I don't know, for 2 weeks, every single day for probably 12 hours. We did not sit on a table and work, right? We went out with jet skis, we went out to party, we rented a boat, stuff like that, waveboarding. We were doing all of that stuff. But every small talk was business, constantly. That was how those guys were working. And for 2 weeks we were doing that. And after those 2 weeks, there was one idea that came out, and he was like, yeah, it's probably going to work. And he didn't find anything bad about it anymore. And guess what? It actually worked pretty well. And the point is that he was the control of the group, right? And he was focusing on the negative things, not because he's a negative person. He's actually a very happy, positive person. The thing is that he was trying to break the idea, and when he tried with all his strength to break it and he couldn't, well, then it's probably going to be a good idea. And that is the complete contrast to what a retail trader does, where he just comes and he's like, oh, I got this strategy, it's amazing. Maybe he'll bring on a friend and he'll be like, oh my god, that's amazing. They just hype each other up, put some money in the account and just blow it within 2 seconds. That's the average retail trader, right? Not thinking about one single obstacle that might happen, and if someone brings it up, they just brush it off. They don't actually think about it and fix that problem, because fixing that problem would mean to get unhyped, right? And realize that what we have is actually pretty shitty and we need to work on it, and that might take a year or two to figure it out fully. And you don't want to do that. So what's more fun is to actually sit there and just be all excited and then, lose your account in 2 days. And then you're just going to do it again. Because that's what gamblers do. And the account or really trading has been designed the same way as a casino is designed, in order for people to come back and lose money consistently. So that's the difference between what market makers do and what retail traders do. And one other thing, before you can break a strategy, before you can start building a strategy, what you need to do is you need to understand the core market principles. This, what I just described, we have ranges, we have, we have moves between the ranges. That's something very, very basic, to understand. Another very important thing is to understand, okay, how do market makers make money? Well, there was actually a really good example that I looked at yesterday, which was right here. Give me 1 second. I think it was, yeah, it was right here. Maybe I can go to the 15 minutes. So here's how a retail trader, sorry about that. Here's how a market maker would trade this. So there's a range here, right? And actually, let me put some stuff away here. Okay, so there's a range here. And what a retail trader would do would be like, okay, so here's a range. We touched this level. I'm probably going to short it. Nice, we had a nice short. I'm probably going to short it again. Now we're probably not going to hit it. And they just start shorting. People start trading this range, right? What's like everyone and their mom going to do? They're going to put their stop loss above this higher level, right? They're going to put their stop loss above this higher level, obviously. So after, this has been going on for 3 days. So after 3 days, guess the liquidity that is in stop losses right here. So there's a lot of buy orders right here, right? That will trigger when the price goes there. But people, retail traders are just trading it. So now let's assume that I'm a market maker and I want to trade this with $50 million, and I want to short this range with $50 million. What am I gonna do? Okay, well, I can't just market sell $50 million, because what would happen would be a huge huge move in the market, and it would eradicate all my profits completely, right? 1 second. Sorry about that. Okay, so if I traded $50 million and I want to short this, then I can't just market sell, because I would just move the price so much that I would not be able to actually enter, and my average order would be at the bottom of the range, which is something that I want to exit. So that's not going to work. I also just can't put a bunch of orders here because they're just not going to get filled. It would work as a ceiling for the price because there's just too much liquidity there. So what am I going to do? Well, I know, especially as a market maker, I know that there's probably 100 million in free liquidity right here, right in this pocket, because people put their stop losses here, right? So what am I going to do? Well, in this area where there's a lot of buys, right? Because it's shorts exiting, so they're buying back. So there's a lot of buys here where I put a lot of sells. So I would put $50 million in orders right here. And I would not put it into the order book, by the way. There's algorithms that do that, where I can set the order in the algorithm and then it fills that order with the exchange. So I don't have to put it in the order book, so people don't actually see what I want to do. So that's step number one. Step number two is when the price is close to the top of the range, I will market buy. I would actually market buy. I'll market buy like $10 million. And what will happen is that I will move the price up, because that's the same reason why I don't want to market sell in order to enter. I market buy $10 million. I shoot the price up and I start triggering the stop losses. And those stop losses will start filling my orders, my sell orders. And at that point, after I took out or after I entered as much as I wanted to, there was a huge transfer in cash or in the asset, and that will dump the price down to the levels that I probably put my take profits on already. So now within like 2 hours, I made my 5% on $50 million, and retail traders that were trying to short this just got stopped out, and they have no idea what happened, and the move happened without them, so to speak. The move happened without them, and they're just sitting there on the sidelines, whereas the good position, right, that those retail traders do, they just handed it over to the market maker that came in here, and he took all the money. And that's how a market maker trades. And so, and basically the reason I was talking about this is because whenever there's a big move coming up, what usually happens is that we will overshoot the range. So there's usually a stop loss hunt, like here. There's usually a stop loss hunt where the stop losses usually are before we go further up, because there's a lot of liquidity, and that liquidity gets literally like curated there in order, like it's literally aging there in order for market makers to come and pick it up to actually do the move that they want to do. So that's a core market principle. Another core market principle that's very important to understand, because if we don't understand it, then we're just going to set our stop losses to levels that will get hit all the time. And then, we might be smart enough to realize that they get hit all the time. So what we're going to do, we're just going to put it higher, but we don't understand why. One thing is to put the stop loss higher. The other thing is to look at the range, see how long the range has been trading, meaning how many stop losses there's going to be above the range. The more stop losses there are, the juicier it is, the more worth it is for a market maker to market buy in the opposite direction in order to pick up that liquidity. So what do we do? What do we do in this scenario? Well, because we understand what market makers do, we understand that these ranges are filled with liquidity, and these ranges are something that market makers want to tap into. So instead of shorting it here, what we will do is we'll actually put a bunch of sell orders in this exact range, and what will happen is once the stop losses get triggered and the market makers enter, we enter too. The difference is that, if we don't trade with $50 or $100 million, they don't care if we take a little bit of their liquidity, right? Because it's literally pennies, what we trade with. Like $50 million is pennies to institutions. So we enter here, and as opposed to having a trade where we enter at the top of the range, have our loss, and then just get stopped out, what we do instead is we will enter it with understanding what's going on in the first place, and we'll have a really, really good entry and be profitable in the trade constantly. There's not a time in the trade where we have not been profitable because of how we entered, because of the deal that we took. So that's something very, very important to understand. So we need to understand the market moves. We need to understand how market makers trade those market moves. And we need to understand, trend following, trend reversal strategies. Those are very, very simple strategies. For an example, what most people in the Discord trade, and what we trade a lot, and that's something that most of our strategies in the dashboards are based off of, right? I mean, there's different evolutions of them, but in the core, those are what they're based off of, and those are that's a stock strategy, basically, which is a trend reversal strategy which measures where the price is away from the average with the help of stochastics, and then putting different time frames together and looking at different perspectives in those time frames. What will happen is that we'll have a larger confirmation if the price is actually going to go up and down, and based on that, that's what we trade. So it's a great strategy. It's a really, really good strategy. The problem is that the learning curve is a little bit steep because we need to look at so many different time frames. That hasn't stopped, many people in the Discord. Hubert, Ritz, Saifa, like they're trading specifically the stochastic strategy, and they're doing really, really well with it. Especially Hubert, who's a great teacher, by the way. Thanks, Hubert, for helping. But yeah, it's a really, really good strategy, and the reason it works is because it's so simple. Something also I've mentioned, but I've been looking at a couple of weeks ago, I've been looking at the dashboards a little bit more thoroughly. I usually don't, because they're usually just trading, and most of the time I don't even look what's going on. I just know that they'll be profitable over a period of time, so I don't even look at them. But I looked at them a couple of weeks ago when I was talking to Alex, who was a big help in developing those. He actually is the one coming up with the ideas of the strategies, and I'm the one that was executing them and putting them from paper to code. And I was talking to him and I was like, yeah, like the dashboards, like they're still the most profitable strategies I've ever seen. And he was like, yeah, obviously, because they're so dumb. And I thought about it. I was like, yeah, exactly. They're so simple that they need to work in general, and that's the point. So the stochastic strategy is one of those things. However, we need to understand where it doesn't work as well, which is when does a trend reversal strategy not work well? Question. The reason, the answer is in big trends. So when we're trend following, then it doesn't work well unless we catch the bottom of that move or the top. So that's something we need to be aware of, and that's something that we need to filter out. However, in a trend reversal strategy, the hit rate is very high. So as long as we trade with understanding how market makers trade and getting really good entries and really good deals on our trades, we have a very high risk to reward ratio, and we have very high win rate. So as long as we manage our risk and manage our losses, it's a very consistent and very profitable strategy. The downside there as well is that there's a little bit of a steep learning curve because of looking at different time frames, but that's why we started using some automation and making it easier for people to trade that. For example, we have our overall porcupine indicator that looks at the stochastics of all the time frames, something that you would have to keep doing manually, but instead have the overall score of all the time frames on one chart. As you can see, it works really well, where the peak of this move is pretty much the exact peak of the price. And this happens every single time. Peak of the move, peak of the price. Peak of the move, peak of the price. Every single time. Peak of the move, peak of the price. So, and that is because it's literally doing what we're doing manually, but the difference is that instead of having to look at it manually, we look at it automatically on a lot of different time frames. Then we also have the overlay indicator, which takes a step back and says, okay, what are the higher time frames doing as well? Where are we aligned in times where we actually can trade? And all those together with Bitcoin, all those coins together with Bitcoin, ETH, and all of that are signals that trigger and send messages to us in the Discord. So there's some help to where we don't have to actually do all of that manually, right? I'll turn it off because it's a little too much. So I usually don't have it on even. I just look at it on the signals. So that's one thing. Another thing that we did now with the overlays and the signals is make the strategy for it. So and that is something that's very basically it summarizes everything that we just talked about. So we have our strategy, we have the understanding of the strategy, and then we have an understanding of the core market dynamics of that strategy. Why does the strategy work in the first place? Well, because if we're at a peak or low, and a lot of different stochastics tell us on a lot of different time frames that it's the top, the chance that there's some kind of retracement either to the downside or to the upside is very high. So as a scalping indicator that's supposed to trade automatically, that's what we want to capitalize on. So what we did was look at the lower time frames, make a scalping indicator, wait for a very good time to do the entry, and at the very high probability time, that's what we trade. So maybe I can actually pull it up here. Yeah, that's a strategy. So this is on Bitcoin, and by the way, this is something that I finished and I have not been optimizing it at all. This is the first number that I've seen, but over time I will optimize it quite a bit more. The good thing is that there's a bunch of settings, and those settings can optimize it actually pretty well. And we can go over them, but really the where we top out, where we bottom out on the stochastics, that's kind of self-explanatory. There's a stop loss level and the time frame that we exit on, basically. So yeah, and this is something, I think it's 2 months, but what I can do here, I think, is if I do the deep back testing, select from the first date possible, then we'll see overall the strategy. Let's take a look. It's actually interesting, but you can see where it trades, right? So they're very, very small trades. So, this is in order so it can run automatically. But if I was trading this myself, okay, yeah, so it's looking pretty good, even looking at more data. Of course, it can be optimized, but, overall it's decent. So I like the profit factor and the percentage, but really the point is that you can see where it trades. So it trades whenever we have big overlays. You can see if we overlay, it actually works together pretty well. You can see the stochastic is down, the score is down, the overlay is bullish, and the strategy long, right? You can't have more confirmations than that. But really the point is that it exits pretty early, and it exits when the 1 minute turns around. So that is what that means, is that the fact that it has a very high percentage rate over a lot of trades, and that's because it trades a very, very high probability move. It says that when we have everything aligned, then the fact that the price is going to go higher at least till the 1 minute tops out, like that's the minimum that can happen, right? And that's what we trade. That's what a scalper trades, because those are super, super high probability trades. If I was trading this manually, okay, and I look at the lower time frames and it's topping out, but my 5 minutes still going well, my 3, 15, 30 are still going well, then yeah, I'll stay in it a bit longer. But for an automated bot, our entries and exits should be the highest probability, because as we do that over a longer period of time, we want to make sure that the principle is generalized so we don't have to change it, right? Let me look at, say, ETH. And yeah, so pretty much same thing, where we trade small moves, but those small moves are very, very high probability moves, and that's what the scalper is doing. Right, so we have our overlays to trading, we have our stochastics, our standard stochastics, we have the score, which is probably the biggest help in looking at what the stochastics are doing on the lower time frames, and then we have the scalper as well, that's just doing it automatically anyways. So those are some helps where we can take our strategy that is simple, but might take some getting used to because of the strategy. Like here, look, for example, like it got pretty much pretty close to really, really good top, but it exited way before the entire move. And that's because it's a completely different strategy. This strategy is not trying to trade ranges. The strategy is not trying to trade big moves. What it's trying to trade is the small move that is almost guaranteed when everything aligns in your way. That's what it's trading. And that's, that is partly also how algo trading looks like, very similar to this, which is very small occurrences. But in this case, we don't care what a market maker does. We don't care what news come out. We don't care about any of that, because what happens is that this is just a natural reaction of the market, of any market, by the way, of any market, that if we are too deviated from the average and there's too many confirmations, that we will deviate back at least a little bit, and we're trading that at least a little bit. So we're really maximizing the probability that our trade is going to go well. And thanks to that, we can have a strategy that's actually pretty consistent here. So and there's very similar approaches here. It's just on a much larger level. The point of these strategies is that we can trade a lot more, right? 7-8 figures. So the point of that is that We have multiple strategies that overlay and they're very consistent, but those trades themselves, they're much larger. So if I go to Solana, for example, the average duration of a trade, 6 days, right? If I go to Turtle, it's probably going to be like 8-10 days. Probably, maybe some of you remember already. But yeah, that's around the time. So it's much slower trades, which also means that we have much more time to enter. And because of that, thanks to that, those are higher probability trades over a longer period of time. So the best approach that I am doing right now is, first of all, I'll start scalping this right away, right? Which, it's not that many trades, and on average it's like a trade a day. But once you play around with the settings, then you'll get much more trades out, I'm sure. I just haven't been optimizing it at all because there were so many things to do. So definitely scalping it. Then day trading, my normal day trades, right? Which averages 10-15% a day. Then actually like 20% a day, but we're aiming for 10% a day. Then we have the scalper, which just trades automatically, and then in the background you have the dashboards that are trading longer trades, which are slower but higher probability. And this has been like, the data here is from 22, but we have like that has been live even longer, and since April we haven't touched it once. So there's a lot of data, live data, to back this up, and you see the consistency, and it has been going through any market sector or any market environment you can think of. So that's a good setup that is coming close to how market makers trade with institutional traders without the fact of making sure to, without having to trade with $100 million in order to move the market. So yeah, exactly, man. Exactly. I'm looking at the chart Han sent. Like, stop losses literally like pretty much gives away so much liquidity, and that's literally what retail traders do. They take away liquidity. They store liquidity for someone to come and pick them up. That's essentially what's happening. So yeah, that's all. On top of that, when we have like how we trade, that's something that we're going to cover tomorrow. This is the theory, right? Wherever there's human input, now that has to be controlled because it's human input, right? So there's emotions, you can be triggered, whatever happens, right? So that human input needs to be controlled and watched over in order so it executes at least, not even close to an automatic way, but just in a somehow consistent way. So in order to, that's something that we're working on right now with the trading journal, which will be an AI journal where you can input your trades, input all the notes of your trades, and then overall you'll get an analysis of your trades and what you need to work on, what you can't work on. That's probably going to be done tomorrow, maybe the day after that. And then we have something very exciting coming the next week, something you guys might like regarding to funding. So that's all from my side. The indicators, the dashboards, all of those things, some of you guys might have it. If you guys don't, you can just DM me or anyone else. You can just DM me if you want, and I can show them to you. And other than that, make sure you get the member role and make sure you get your affiliate link, because you're going to need that for the trading journal. I can tell you right away. Last time we did something like this, people got the Orca role for free, which was a pretty big giveaway. So make sure you get your affiliate link so you can get people in. The way you get the affiliate link is you go into anywhere basically, and you do into any chat in a Discord, you do /invite and you send it to Jellyfish, and as you do, you get your invite link. That's what I did in the chat right now. So yeah, there's that. That's everything from my side now. If you guys have any questions, let me know. I know Hans wants to say something, so I'll put you up here. Any other questions, let me know.
right, here we go. Here we go. What's up, everybody?
What's up?
Chilling, man, out here, working with being dad, usual stuff. Yeah, bro, I feel like what you just said about the market makers and how they fill the orders is super important. And I understood that concept maybe the last year or something like that when it comes to like liquidity and what it is and how it works and just like maybe some people in the call aren't gonna fully understand it on the first take, but as you keep learning and you keep trading, you'll see more of that happen. So like the image I sent on chat is a liquidation heat map. So the liquidation is essentially when the trader is forced to close the position. So like if you look at the image, it shows you different colors. So the yellow is like the highest liquidity, and there's different time frames too. So the 12-hour time frame is more like the intraday liquidity. So I like to mark out the yellow areas. That way I know like, okay, there's a liquidity here, and then it lines up a lot of the time, pretty much every time it lines up with like a high or like a daily high, a session high. Like right now, we ran the liquidity already to the downside, but on Bitcoin, the liquidity on the upside rests above the Asia high. So that's just like an example right there. So like people are going short or going short, and that liquidity just stays up there. You know what I'm saying? So like it may come back at some point, and then it may go away because the liquidity can go away too. Because if people close their positions without getting taken out, the liquidity goes away.
Right.
But
right. So.
But yeah.
Yeah, and what's important to note as well is like when we say liquidity, it depends on the side, right? So when we have shorts, then that is basically buys there, right? So that means that when you stop someone out, basically, or you liquidate someone, what that means is you're forcing them out of the market, and they are forced to sell their positions to you, and that's a core mechanic that market makers use, which retail traders aren't even aware of. And that is, when you look at the liquidations, surprise, surprise, for most people, the stop loss is their liquidation. So what they do when they have a trade is they will max out the leverage they have to a point where their stop loss is the liquidation, and then they think that they're actually risk managing in that case. Like, I swear to God, people do that. So, where you see the liquidations is a pretty good correlation to where stop losses are as well. And based on that, one thing is looking at a current range where those are, right? Which helps a lot. The second thing, though, is looking at patterns on specific coins and also on the overall market. Looking at patterns, how where usually there have been the biggest liquidations based on how the price was moving. And by learning that and understanding that, you'll be much better setting your take profit and stop losses and entries, by the way. Setting your entries at liquidation levels is probably the biggest cheat code I can give to anyone listening, because your entries are going to be like, people look at your entries and they'll be like, how did you catch that? And the point is, you didn't catch it at all. You just saw where the liquidity was, and liquidity is something where the price is attracted to, because people need to get to that liquidity in order to enter and exit, right? Those are big problems. When you have a big position, when you have a $200 million position on an altcoin, then you need a lot of liquidity in order to exit it. And let's say you need to exit it right now. Well, that's a big problem. So you will be pushing the price for weeks, if you have to big liquidity pockets in order so you can exit out. So that's a very, very important scenario or something to wrap your head around, which will directly improve how you trade drastically.
Right. So that's another thing too. That as people who are new to trading, they don't understand how positions work, like shorts and longs. I'm sorry, I was gonna call you Alex. Like Phil said, when you close out a long, the only way to close a long is to sell. The only way to close a short is to buy. Whether you're getting stopped out or taking profit, it's the same way to enter and exit. The position. So it's like another thing too that you can do, if you're not comfortable with just setting. Hold on. What happened? Sorry. And if you're not comfortable with setting limit orders at the liquidation levels, wait for the liquidity run to happen. And then if the move is going to happen to the whatever side it is that you're expecting, then go in. So I would suggest to wait for the run, to wait for the liquidity run. I could also share the website that I use. It's free.
Yeah.
So you guys can map out, I use Bitcoin. So Bitcoin is the most liquid asset in the crypto. So I use that one, but doesn't matter. It's okay. Hold on, buddy boy. Other altcoins, they have low liquidity. So it's just like, for people who haven't traded other markets, you guys won't understand illiquid and liquid moves. Like illiquid is like when you have like a crazy wick and nobody can, and you know what I'm saying? It's like, and not a lot of people can enter on that move. You know what I'm saying? Like the price just passed by very fast.
Right.
That's why I use Bitcoin. So that's something to take into account. Just like, okay, you want to trade assets with high market cap, which is a high liquidity. But if you're gonna trade an altcoin, obviously be aware of what you're getting yourself into.
Okay.
But for sure, I'll share this website with you guys so you guys can run some of this stuff and see what's up.
For sure. Send it in the chat, and then we'll post it. We'll pin it somewhere for everyone to use. For sure.
Okay.
Yeah. All right. So I think this has been quite a lot of information thrown at you as always. So I think we'll stop it here and set it up, or keep covering it tomorrow. If you guys have any questions, just DM me, DM Hans, DM whoever. Questions about indicators and so on, I'll answer too. And other than that, if you guys don't have any questions, thank you. I'll post that link into the Discord, and other than that was all, and I'll see you guys in the Discord.